Good morning and welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend, special guest, Dr. Friday with Dr. Friday's tax and financial firm in Brentwood, Tennessee. All right, we hit our first strategy, which was on bunching. Now we're going to talk about, again, if you want to, one of the things when it comes to planning for retirement is thinking in terms of tax efficiency. It's so important. We talk about all the time, it's not just what you make, it's what you keep. And keeping more of your money, one of the ways to do that is pay only the amount of tax that you're legally required to pay, not to pay excess tax simply by not knowing how these tax laws work. So an example was this bunching thing, okay? So think of that. There's a strategy. The rules are the same for everyone. Someone that doesn't employ that strategy is just going to pay more tax. Right? You're going to just be paying more tax every year. The IRS isn't going to give you a phone call or send you an email or send you a letter saying, hey, there's this thing called bunching that you can do, right?
Exactly.
Their job is to collect as much tax as they possibly can. Now, if there's an error on your return, good or bad, I will say they will correct that whichever way it goes, okay? Unfortunately, usually it's the bad part, all right? But when it comes to saving as far as strategies, that's not their job. If you called them and say, hey, can you help me reduce my taxes? Not their job. They're going to tell you, we're not here for that. All right, so here's where this kind of, and I'll tell you another thing, they could get into trouble even if they were so inclined to try to do that, because that's not, they're not trained to do it is the other part, and there are certain legal liabilities if they gave you bad advice. So they just stick to their knitting, which is collecting as much tax as possible. If you call and ask them what the deduction is, they might could tell you that, all right? Here's the thing. Strategies like this are important for you to understand to keep more of your money. That one strategy alone could be worth thousands, tens of thousands of dollars to you, maybe even more than that if you think about it over your lifetime, okay? So here's another. We're going to talk about some of the differences when it comes, we were talking about with that, as I said, bunching means like your charitable deductions, you're paying your property taxes, doubling up on those in that 1 year. Another part of that is how, with the tax law, is how these have changed. So how, as far as your property taxes and your what's the other one? Local taxes, sales taxes, and that. How these limits have been put on these. Before we jump into that, again, if you would like to have some of the, us to look at your specific situation to help you with some of the strategies we're going to be sharing today and others that we probably won't have time to get to, I'm sure, because there's so many. Then just call my office. The number is 615-376-5325. We've got people standing by. They'll get your information. They'll send you out a checklist of things to bring to your appointment with me. And when you come in to see me, we're going to do a complete comprehensive plan for you. So that's why we're going to have you bring documentation to help with that. An investment analysis. Bring your brokerage statements and we can give you an investment analysis of your current investment plan. We'll show you Morningstar reports. We'll dive deep into the kind of mutual funds you have and what are in those mutual funds. Talk to you about the difference between active management and index strategies and how important that is to you, not only as far as taxes, because indexing is much more tax efficient than active management, but also as far as performance and reducing risk. Indexing, again, is going to be superior to active management over that. And I say this because there's so much research that's been done to prove that point. All right, and we'll share with you this knowledge and again, show you in your own. Imagine this, if I could show you your financial future based on things you're doing, if I can show you, for instance, in your current portfolio, there is a measure, it's called standard deviation, and we tie that to the market. So it'll show based on the market standard deviation, we can look at yours and see in the next bear market how your portfolio would hold up. Will it drop as much as the market does? Will it drop even more? We can show that to you and basically quantify this for you so you can see the type of risk you're carrying, and then at least you're making more educated, informed decisions as far as your planning goes. And that's a big part of the planning. I can show you your financial future based on the things you're doing and then share strategies with you to improve that future, to make sure you're going to have that lifestyle that you desire, to be able to thrive in retirement, not just survive, not just get by. We want to have fun. We want to enjoy it, right?
That's right.
All right, so let's talk about the difference now with the new tax law with regard to housing.
So with housing?
Yeah, with
or
the
salt?
Salt.
Okay,
yes.
salt. So bottom line is, under salt, basically that is your state income tax, in some cases alternative tax, property taxes. Those are what makes up salt. So in our case, we have a sales tax instead of state income tax, and we have a property tax. We don't have a personality tax here. Some states do, California being one. But so when sometimes people will put their auto registration, that isn't qualified in Tennessee because we don't actually have a state income tax, therefore you're not deducting something. But just so you know, so you have your property taxes and your sales tax. Sales tax can be interesting. A lot of times, and this has been proven in my office, you can do it yourself, but if you physically, you have a choice. You can take what the IRS calculates based on your income and a calculation of percentage, how much sales tax would be used. The alternative is to track real sales tax. Some people actually have like credit cards they put most of their things on, or they save all their receipts. And I have physically had boxes of receipts come to my office and show me, you know, these are all them Friday. I'm like, okay, what's the total? Yeah. And almost always they're thousands of dollars more than what the IRS showed for the percentage. So it may be something you consider, especially if you're relatively close when it comes to the itemizing. Remember though, when these taxes under the new law, before this, if you were, I have clients in other states, California, for example, I use this one a lot. My brother, his wife and him, they have a state income tax of almost $30,000. They have property taxes of another $5,000. They can only claim 10 of that $35,000.
Yeah.
No matter how much they paid in, 10 is all they're going to get. So just keep in mind, nice to live in a state with no state income tax. I say no state, but we do have the halls.
We do have halls income tax.
It's not an income tax, but we do have a tax here.
This is one of the areas too, and it's fading away. It will go away, but one of the areas here in Tennessee, then you may not have to worry as much as far as that limitation goes. It may not affect us here as it might in other states, as like Friday said. But here's something to consider as well. I know many of my clients have property in more than one state.
Absolutely.
So now we have, you know, if you're combining these, this limitation can be harmful then.
It could be. And again, for myself, even because I do that even out of the bunching that we were talking about, and mine would always exceed 10,000 in the past. Now I'm locked in, so I'm not getting quite as much as I used to between my sales tax and my 2 property taxes that I used to get.
Well, you got property taxes, and then how about mortgage interest? How does that
Now
work?
that mortgage interest, no limitations. That is in there, but keep in mind, if you purchased a home after January of 2018, a new mortgage, you could only use up to $750,000, and that includes your first and second home if you are using a first and second home mortgage situation. Used to be $1 million, now it's $750,000. So that is also some limitations to some individuals that you'll have to be careful with. And if you use the line of credit, a lot of people for many years would get a line of credit, go pay off credit cards, go buy a house, pay off the student loans, whatever, and use the interest on that line of credit on their thing. That is not allowed any longer. Lines of credit are allowed if it was used to buy the home you're living in, first or second, if it's tied to the home. If you used it to pay off other debts, it is not a tax deduction any longer. I don't know if you remember, Hank, about 10, 15 years ago, we used to be able to write off credit card interest. In the day, you know, I mean, and so I think people found a way around that, right? So they would get mortgage interest because that was the way, and now the IRS has said, wait a second, we eliminated this once, now we're gonna have to eliminate it again because most people are using lines of credit for other than their primary home reconstruction improvements.
So, and you know, this is an important part because I think, you know, I know I have people come in and still are thinking, you know, I'll do this home equity line. And then I'll be able to, you know, pay off all this, you know, pay off some
higher interest
notes
debt
and stuff, and
consolidate
and be able to deduct the interest. So that no longer applies. In addition, you know, when it comes to your mortgage interest, the same thing. They're not, you know, unlike property taxes, which is saying 10,000 cap, they're not putting a cap, but they're capping how much of a mortgage you could have. And again, think in terms of potential multiple properties, you know, how that might work. Now, on the tax part, as like Fry was just saying, the HELOC, you can't do it, a home equity line. Now, if you refinance your home,
take cash out.
Now you can, you know,
but then you're locked into the
$750,000
for multiple homes. So it is a problem, and
goes back to the strategy. This is so important to understand these rules. You can see how you could unknowingly go out and get a HELOC, pay off all these loans, thinking you're going to have write-off, and there's no write-off. Where you could have refinanced, maybe, you know, and we know you want to compare costs.
Right.
you know, of the financing, because refinancing typically is going to cost a bit more potentially than a HELOC might cost. But are the tax savings going to be worth it, and is it going to accomplish those goals?
And I think you end up with an 80-20 used to be, so you're going to usually take 80% with a refi and cash out, even maybe less depending on your credit. And so that's why the HELOC was nice, because they would give you that extra 20 in a short-term period. So yeah, you'd have to definitely talk to a mortgage person to get the numbers.
And it gets into the financing too. We're gonna take a break, but when I come back, one of the things we're going to talk about with all these strategies, as important as this is as much as it can benefit you, you have to look at the financial picture first. Then the tax piece is like the icing on the cake.
Yeah.
All right, because if it's a bad financial decision,
Then don't do it.
tax savings isn't going to necessarily make it a good one, okay? And we'll give you some examples of that when we come back, and some things for your own situation, hopefully, to help you with that as well. So join us here. We'll be right back on the Retirement Report.
This comes to